The multiple time frame analysis technique is something that I'm sure many traders have heard of. Whether it's this structured triple screen trading method or just looking at a time frame 4 times higher than your trading chart, this analysis can assist you in your trade decisions. Now, one thing that confused many traders is using multiple time frame analysis in terms of trend. Trade in the direction of the higher time frame trend is something we've all heard from the day we began trading. I don't always use that methodology by taking a quick look at trend indicators or general price movement, but I attempt to gain more information from the higher time frame. And the best way to explain how I would use this is to look at a trade that I took in the CHF JPY Forex pair. Now, whether it worked or not wasn't the issue, because it was going to be a success anyhow because I followed the trading strategy. Now, judging your trading on results is a losing proposition, considering that regardless of your trading system, you will take multiple losses in a row, and the expectancy research you've done is going to show that. Now, basing your failure or success on properly implementing your edge, whether it's multiple time frame trading or single chart analysis, that's much more productive. Now, this is the daily chart, which is the chart that I generally look at for setups during the analysis, and it's the first chart in the multiple time frame analysis that I want to talk about. Number one here, we have a triple top formation. It's certainly bearish, but what's interesting is the bears were not able to push price a great distance. Number two was temporary support, but even a break of that, as indicated by the candlesticks, doesn't convince me that there was a lopsided battle going on at that point. Number three, the strong push into the zone was halted. Number four, not used by me, but added for those that use it. It's the 50 period SMA, which would disallow long trades as you wait for a pullback. My trade is a long trade, but I'll quickly add that I was not trading support. I do trade the support bounces, but there are certain parameters and patterns that I will look for in these locations. And overall, the daily chart's a mess, and it qualifies as a range-bound market at this point, but it hides a common trading tool. Perspective is given through a higher time frame analysis on this pair. This weekly chart highlights how strong this up move really was in this currency pair. If you were to put an oversold, overbought indicator on the chart, it would indicate that this market was overbought. And the general rule is to stand aside and anticipate a reversal in price. What the indicator doesn't tell you is that even after a move like this, a consolidation can actually work off that overbought or oversold condition. A big retrace in price is not written in the cards during these conditions, and that's something the textbooks don't really teach. Number one, this consolidation, the high and tight flag, may be enough to work off 8 weeks of that upwards drive. Number two, this failure test of lows as price broke through and on the same candlestick drove straight back into what appears to be that range. Number three, this inset is the consolidation, but you can see with the black lines here, that we're actually looking at an A to B equals C to D price movement, also known as a complex correction. Taking everything from the multiple time frame analysis into context, you can build a case for taking a long trade. And again, this is not simply seeing a support zone, although it could not be called support until after price rejected during the second visit. So now, the daily chart's messy. The weekly chart smooths everything out. A strong bull market emerged and continued for the last 8 weeks. Indicators are going to show overbought, and price has gone into consolidation at the highs of that move. The consolidation is trading 1-to-1, as in both pushes and price are equal, and price had broken a zone of potential support and snapped back inside. So this tells me the bears at this point are not strong enough. So I go back down the daily chart for the trade entry, and you can see in the chart below it was a buy stop above the candlestick that helped build that failure test on the weekly chart. And I use an ATR stop that was entered when the trade triggered. And once price went in my favor, at the end of the day, I cut the risk virtually in half, and the stop was sitting at the low of the day. Now, some traders may be surprised the current stop location was not the initial location. The fact is that too many traders use tight stops so they can have a larger position size. That's the wrong way to set your stop, and you're really a sitting duck for stop runs. That said, if I'm triggered into a trade and there's a strong momentum move against me, I'm not going to wait for my stop to get hit. When you enter a trade, especially on the back of multiple time frame analysis that leans in one direction, strong moves against you point to trade failure, not success. My initial stop is far away enough for wiggle room and allowed a triggered trade time to mature. Once there's a push in my direction, if price returns to the base of the thrust, it's not a good sign. I'll take a loss, but it'll be much smaller than the one that I had planned for.